Tom Bowley, Chief Market Strategist here at EarningsBeats. Hey, good morning, everybody, and welcome to this Wednesday, December 6th, 2023 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes or so as we prepare for another strong day ahead, at least based on futures. It looks like we're going to have a pretty good session. Let me see. I want to get one thing set up here before we get going. All right. Yeah, we just had the ADP employment report out. And what I was hoping for, what I was looking for was a positive report, but one that was a little bit less than expectation. For me, that would be nirvana for stocks, simply because without strong earnings or strong jobs growth, then I think the Fed probably will have no choice but to stand pat at their next meeting. I mean, we've got inflation numbers continuing to come down. So, and we do have inflation reports that'll be out later that we'll have to also take a look at, though I think they'll be out next week. But this is this was a pretty good number for the Fed. We came in at 103,000. The expectation was 123,000. And then also last month, so the number I just gave you was for November. So if you go back to October, the actual number that had come in October was 113,000, and that's been revised lower to 106,000. So what this is saying is that maybe the economy, which had been very strong in the last quarter, is going to continue to cool off. Of course, we still have non-farm payrolls on Friday, and that's the one I watch most closely. But this is the latest information that traders have. And so you're looking at an economy that seems to be slowing a little bit. Inflation's coming down. There's really no reason for the Fed to even talk hawkishly at this point. So that's the good news. And again, I think that's why we're seeing futures tick up. They were already up a little bit overnight, but they did pick up this morning and more recently. And I believe a lot of it has to do with this fairly, not weak, because we are showing positive job growth, but just weaker than expected ADP Employment Report. But again, I want to see what is going on Friday before I want to make that determination for sure. Because sometimes we get completely different reports, the non-farm payrolls versus the ADP employment. So we'll hold off on that one. But at least for now, the news is pretty good. And I think that's why we see the futures jumping. We had nice leadership yesterday from one of the big names, Apple. I think Amazon and the Broadline Retail Group also had a pretty good day. So both of those helped the NASDAQ recover a little bit from some of its relative underperformance that we've seen uncharacteristically the past few days. I wouldn't be surprised, though, to see still a lot of emphasis on these small caps. They were off yesterday. In fact, on that note, let's go ahead and take a look at the action from yesterday. So we had the Dow Jones Industrial Average down 80, S&P 500 down about 2.5. The NASDAQ 100 was up 38. Mid caps down 35, small caps down 2.5. Even though small caps were only down 2.5 on the IWM, that was 1.34%, same as the mid cap. So that was clearly where your weakness was. The transports, which recently broke out of that bottoming head and shoulder pattern, I'll show you that just a little bit. But that broke out nicely above that neckline. It pulled back a little bit, gave away some of those gains. Still looks pretty good on the chart to me, though. And if you look percentage-wise across these major indices, the Dow drops 0.2%. The S&P was down less than 0.1%. NASDAQ was up about 0.25%. And then again, mid caps, small caps, taking it on the chin a little bit there. So overall, bifurcated market. Saw a little bit of strength in the NASDAQ, saw weakness other areas, small caps lagging. That's kind of the summary for yesterday. Technology did gain about 0.6%. The discretionary group up about 0.2%. These were the only two sectors that were in positive territory, but they were good sectors to be in positive territory. Those are two of our three really aggressive groups. And then to the downside, energy, crude oil prices just continue to struggle. In fact, this morning, Yeah, last time I looked, they're still down. They're down 1.6% to $71 a barrel. This goes back now several months since we have seen crude oil prices down at this level. So energy taking it on the chin yesterday, not far from breaking down again. And as I say many, many times on here, I don't personally like to trade energy because just when it seems like they look great technically, they just completely fall apart. And now they look like they're ready to break down again. I don't know. Maybe we'll be back up to 92.5 on energy in another few weeks. That's the way it seems to go with energy. I just can't rely on the technicals that I see, and it's cost me in trading over the years. And just as a result, I tend to just avoid energy and maybe to a lesser extent materials. I think materials are a little bit easier to trade, but energy is tied so closely to crude oil, and crude oil can be driven by a number of factors around the globe. I mean, geopolitical tensions can drive crude oil, which in turn drives the XLE. So the technicals you look at one day can be completely different than what you're looking at the next day. So again, just for me, I tend to stay away. A lot of folks like to concentrate on energy. I know, especially a lot of our folks that follow us from Canada are really big into the energy materials area. Unfortunately for me, I've had struggles over the years really finding out which side of that trade you want to be on from time to time. So again, that's why I don't spend as much time going over that area. Moving on to industry groups, we had the fixed telecom area. AT&T had a pretty good day yesterday. I think AT&T was up 3 or 4%, and as a result, fixed line communications up about 3% on the day. You can see continuing the uptrend that it's had recently. Again, a lot of that is because of AT&T. AT&T's been trending higher as well. Computer hardware up almost 2%, and broadline retail up a little over 1%. There wasn't a lot of strength yesterday in the market. And certainly Apple held up the computer hardware group. You had Amazon holding up broadline retail. Actually, there were some others that did well in broadline retail as well. But those are two big market cap weighted stocks in the NASDAQ and in the S&P 500. But the NASDAQ, of course, was the winner yesterday. And I think a big part of it had to do with both Apple and Amazon. Before I move on any further, I do want to welcome all of you that are following here on our live stream at YouTube. I do want to try to interact here more often as we go forward. So I thought what we would do today is I'm going to open the floor up to all of you for questions. So if you have an individual stock or you just have a question about the market, something that's not clear, I'll do my best to answer it if I know the answer. If I don't know the answer, I'll try to see if I can find you the answer and maybe come back with it on a future show. But anyway, type in your questions. Probably in about 7 to 10 minutes, I'm going to go through a little bit more looking at the market, but then I'm going to come back and spend the rest of the time here today answering your questions. So I thought we'd maybe change it up a little bit. I really appreciate you all coming in and figure this is one way maybe we can improve the community, try to get some questions in from time to time. If you have multiple questions, I don't know if I can get to all of them. We're going to probably have enough questions to handle the rest of the show. But if you do ask some questions, I'll try to at least get to one of them. All right, let me keep going here. 10-year Treasury yield, you can see continuing to make that move down. I know maybe back when this was sitting at 5% or maybe even 4.5%, maybe you doubted that we were going to move back down to 4.10%. But these patterns, I went over it yesterday. I don't want to spend a lot of time here, but we did break down below that head and shoulders neckline. That measured to 410. Here we are today at 4.14%. So if we get down to that 410 level here over the next couple of days, I don't know, we go into that non-farm payrolls report. Maybe we'll be a little bit more careful at that point. But this is just an initial measurement. Doesn't mean we're going to stop at 410. We could continue going lower. But just the beauty of patterns is that they generally provide you measurements after they make their breakouts or breakdowns or whatever. So once the pattern executes, the beauty is that it gives you a target to look for, at least an initial target. And that's what we've been talking about on here, 4.10%. And literally within 3 weeks of breaking it down out of that pattern, here we are at that 4.10 level. Pretty amazing how the technical analysis and patterns can work for you. Moving on to the S&P 500, we've got the S&P still stalling below 4,600, clearly that's a big level. We got up there in July before a lot of more cautious signals started to come into the market. And of course, historically, that was the worst time of the year to trade on the S&P 500, July 17th to September 26th. Historically, that is the worst period. Forget about go away in May and all the garbage that they spew all the time. Going away in May would have really hurt this year. Instead, it's the middle of July, July 17th, over the summer. Volume gets lighter. I think the market's easier to manipulate either way, but during the summer, I think to the downside. And we saw it again this year. Now, it's not always like this. We don't always have a correction starting in mid-July, so don't misunderstand me here. But the tendency is out there. So when you start seeing other warning signs, I know the equity only put call ratio got down, like the 5-day moving average was maybe 0.45 or 0.47, which was the lowest we've seen since April of 2022. A lot of folks jumping into calls. That's not a good thing after you've been going up for a while. So there were some other things, negative divergences. Of course, the seasonality I talked about. Some things, maybe a little bit of rotation that was a little concerning at that time. All of those things factored in and led us to a 3-month period of lower prices. But that's behind us. We've made our way all the way back up quickly to the 4,600 level. Now I'm looking at this, trying to figure out, okay, do we pull back here through next week? Second week of December tends to be the worst week of December. So are we going to pull back here, or do we make one more push? I mean, we got futures up again today. Do we get through 4,600 this week? And then next week, maybe after a brief move up, you can see we probably would have a negative divergence. So maybe we have a swift move down next week. Maybe something comes out with the PPI or the CPI that spooks investors for a few days. I don't know what might happen, but I just know with history, I do think somewhere in here over the next week or so, we're either going to maybe pull back further from that 4,600 level, or maybe we get that breakout first and then we have a pullback. But I do think somewhere, we're overbought. You can see the PPO starting to roll over a little bit. Seems like we're kind of primed for maybe a little bit of weakness. But I'm sticking with the long side for this week. Let's see if we can get through that 4,600. I think the IWM is not trying to get through any major resistance at this point, has much more room to go until we get up to about the 190 level. And I'll talk about that in just a second. NASDAQ, you can see, has already made the breakout above July. It's pulling back, hitting the 20-day. I don't know, maybe we make a push, and you can see that PPO rolling over. Maybe we make a quick push up for that, 16,1 level, 16,150 level. If we fail there going into next week, I would just simply say be cautious. Because again, that second week of December tends to be the week that can get us. I think the actual dates are like the 9th to the 15th. And I'd put a little special emphasis maybe on the 11th to the 15th. That's where we seem to get the most weakness in the month of December. So keep all that in mind. Small caps, the IWM, this is what I was talking about. You got a little bit of resistance going to jump in at about 190. We finished yesterday after pulling back a little bit at 184. I think we've got room up to that 190 level. Look at the PPO here. PPO here is still very strong. So we've got momentum building in the IWM, whereas we're starting to see it kind of like roll over with the S&P and the NASDAQ. So that to me points to maybe more rotation from the bigger, larger cap names into the small cap here, at least maybe for the next couple of days. We'll see whether or not that is the case. Transports, here was that breakout. Here's your bottoming head and shoulder pattern I talked about. Left shoulder, neckline, head, back up to the right side at about 15,200. That's the right side of the neckline. Pulled back at the 20-day moving average, and then boom, volume increases. We break out above that neckline. Now to the downside, sometimes we fail at the neckline, and this is one thing I changed in my trading a long time ago. I used to always think, okay, when it comes back down, hits that neckline, I'm going to get in. Or, as it approaches that neckline, if it closes below the neckline, I get out. Well, the problem with that, and what I realized over the years, was we could close below that neckline and still be above the 20-day moving average. And so I had several times where I was getting whipsawed and getting knocked out of my trade, and then it would bounce off the 20-day and go up. So now what I look at is the combination of that neckline and the rising 20-day. Those are starting to squeeze. We have the neckline at 15.2. We have the rising 20-day moving average on the IWM, or excuse me, on transports at 14,935. So between about 15,200 and 14,935, that's your key area of support right now on transports as I see it. All right, fall special. Wanted to talk one more time about this. I know it's been going on. We actually extended it a few days because of website issues that we had on Sunday. Also, we have changed our the hosting company for our website. So hopefully they've been a little bit unreliable, and especially over this weekend, they were doing maintenance. Supposed to take a couple hours, took all day. Talk about frustration. I was extremely frustrated. Anyhow, we've moved all that. So if you have any problems logging into the website, or you have problems with delays or whatever, let us know. Please support at EarningsBeats.com. We'd like to hear it. But otherwise, we should be good to go. We've noticed everything seems to be running smoothly so far today. Anyway, we did extend our fall special. So you can go to our homepage, EarningsBeats.com, click on the fall special, and come in. You can take your choice. This expires tonight at midnight. So you've got 3 plans to choose from. You're going to save the most money by investing the most in us. We're going to give you the best rate. If you go out 3 years, you will get a full year free. So you pay for 3 years, you get 4 years, and you pay for 3 at a discounted rate. So you wouldn't have to worry about us charging you going forward for the next 4 years. So anyway, that's a great deal, but both the 1 year and 2 year plans also get you some free time with us and bring your costs down. So check all of that out. I do also want to mention that we have announced that our Market Vision 2024 event, to be held on Saturday, January 6th this year, is going to carry a $697 charge for non-members of EarningsBeats. EarningsBeats members will have a much lesser charge. But if you want no charge, use our fall special. Anyone that has used our fall special to date or uses it between now and midnight tonight, you're going to get a free seat into our Market Vision 2024 event. And if you have been to any of these last 4 events, you know that the guidance that we have provided has been nearly impeccable. I mean, it has been right on the money 4 years in a row. And so I'm going to put our reputation on the line again. January 6th, give you my forecast for 2024. So make sure you check that out. All right, let's move on to the chart of the day for today. And what I pointed out here when I sent this out earlier this morning, or actually when we sent this out earlier this morning, I didn't send it out. Estee Lauder, EL, ticker symbol EL. I wanted to point out in this downtrend 2 different types of gaps. So right here, you can see kind of this breakaway gap to the downside. You gap down. You really don't know what kind of gap you have. You have to kind of look at the circumstance. So first of all, from this high in February, we had not really gone down that much. So you're normally not going to have an exhaustive gap if you haven't had that much selling to begin with. An exhaustive gap comes at the end of just extreme pain, just going down and down and down and down and down. And then finally, everybody just throws the towel in, some news comes out, and people can't take it anymore, and everybody decides to sell. And from there, the exhaustive gap is in, and a lot of times we'll recover. In this case, we were starting to go down, and then we had this breakaway gap, which actually led to a lot more selling throughout the rest of the year, all the way until we had what now looks like an exhaustive gap, where we gap down. We have absolutely monster volume on these gaps, by the way. You can see both of them. But here, the exhaustive gap over 15 million shares, we gap down and then right back up. Like, what happened? It's like, wait a minute. We had PPO went to a new low. Volume was huge. We finished down from the open. I mean, it seemed like everything was horrible. Look at the volume, though, over the past month on the way back up. All of a sudden, somebody's buying, probably market makers for institutional clients that now see Estee Lauder as a tremendous value after dropping probably 60 or 65% over 9 months. So we get that exhaustive gap, and then that marks a bottom. I believe, based on what I've been seeing and what I'm seeing right now, that the bottom is in. It doesn't mean we couldn't possibly go down and retest it. I just don't believe we're going back down below that low. I think exhaustive gaps, first of all, exhaustive gaps do mark major long-term lows. So if this is an exhaustive gap, we should not go back down below it. Could we go sideways here for a little while? Sure. But from a longer term perspective, it looks to me like there is major accumulation taking place on EL. And so pullbacks, I think, on this stock are buyable. From a trading perspective, watch these two moving averages. If I got in for a short-term trade, that's where I'd like to get in. If we close below both moving averages, I probably would just get back out. I don't want to risk going back down to 104 or 105, whatever that low was. But anyway, just wanted to point out that the gaps, you need to pay attention to these gaps. When you get a gap and then you keep going lower, probably is either a runaway gap, a breakaway gap, something like that. When you get one after an extended downtrend and then you see buyers come in with volume, that tends to start looking more and more and more like an exhaustive gap. And I think that's, again, what we have here on Estee Lauder. All right, I'm going to go in and see if we got some questions. And so for the next 10 minutes, I will just look at your questions here. Good morning to everybody. Yes, Michael, hit that like button, please. Whether you're here live, whether you're, checking out the recording later, you can help us. Even if the fall special, for whatever reason, doesn't appeal to you, you don't want to be a member of EarningsBeats. Hey, I get it. Maybe we're not for everyone, but you can still help us. We're trying to spread a lot of stuff that you don't hear on CNBC and other media outlets. We're trying to get a lot of good information out to help people make better financial decisions. And to do that, we need a bigger audience. So hit the like button, subscribe, do all those great things. And we certainly would appreciate that. Gold or silver looking any better? Well, again, are we talking about absolute price action or are we talking about relative price action? Because I'll pull up gold and we'll look at the chart. I mean, we just got to break out on the daily chart. We're pulling back. I mean, if this was the only chart I had to look at, I would say, yeah, I mean, in this gap support area, rising 20-day, we're getting pretty close to a level where I would expect gold to bounce and move back to the upside. So from a short-term absolute price action, if I had to pick right now, I'd be long gold. But we all know that there's more to the stock market than just looking at one chart. And the problem I have with gold is that if you study it over time, you will find out that it does its best and it does better than the S&P 500 when volatility is high and moving higher. Right now, we got the volatility index under 13. I don't believe we're looking at an asset class that's going to outperform the S&P 500. Just my personal opinion. I might be wrong. But if you're asking me for my opinion, I don't like gold because I don't think it's going to outperform the S&P. So I would rather look for things that I think are going to outperform the S&P. Right now, I like some of the value-oriented areas because December is a period when we normally see value stocks outperform. And then also because of the way they've traded over the last few days, we're starting to see breakouts in some of those areas. We're going to talk about that more in the live trading room at 10 a.m. this morning. So if you're a member or you become a member here in the next 37 minutes, you can join me in that live trading room and we'll talk more about individual stocks there. But yeah, I mean, here's the problem I have with gold. So rather than just tell you that it's not been performing well, let's just pull up this chart. Let's go monthly and let's go all the way back. I don't know how far you want to go. Let's go 2 decades, 20 years. And if your goal is to outperform the S&P 500, and I hope for the most part that's what everyone's goal is. I know some of you might be income investors looking for things that can make you some money, but maybe it doesn't outperform the S&P, but provides you a little bit more safety, that kind of thing. I get that. But if you're a growth investor, you're trying to beat the S&P 500. Is gold, looking at this chart, is this an asset class or something that you would want to invest in? I mean, it peaked back in 2011 and it's gone down. We've had a couple periods here, a little bit of a pop here, a little bit of a pop, sideways, a little bit of a pop, back down to a new low, relative low. And then we bounced off of that. But really over the last 2 years, it's just kind of been going for the ride. with the S&P 500. It's not doing anything. And going for the ride's not very good when that's in a downtrend, because normally that just is continuation before we make another move to the downside, which I think is coming. So I don't like gold as a relative investment to the S&P 500. Again, if I'm just looking at the price of gold and you said, hey, would you buy it or short it? I'd buy it until it breaks back down again. And then I would get the heck out of it. I don't know that I would short it. I wouldn't want to waste my time and capital trying to short anything, because I think we're in a secular bull market. I want to be on the long side. So gold, I think, is okay as long as we continue to trade above those moving averages. Watch for resistance at 4,600 on ES. Well, 4,600 is the big number on the S&P. Talked about that. Absolutely. Couldn't agree more. I do think I absolutely believe we're going above 4,600 on the S&P. So the only question is whether we do it this week before we get into a historical bearish period. Maybe we go higher next week. I mean, it's not a guarantee we're going lower. It's just a tendency, and it's a pretty strong tendency. But hey, the market's gone up during the second week of December plenty of times before, so don't treat it as a guarantee. What I'm talking about really is just managing risk. So, for instance, if you're in the TNA that tracks the IWM, or you're in the TQQQ that tracks the NASDAQ, the QQQ, next week, I doubt that I will have any leverage. It's just too risky to hold it into a week that I know struggles. Anyway, why do technicals apply to the TNX? Well, it's a financial instrument. I mean, it's money involved. They're traders. So it's going to be subject to the buying and selling. It's the price action is what drives technical analysis. Basically, it's the history that helps us predict the future. That's in essence what technical analysis does. And I would say, I mean, that's kind of the basic definition, is that prior price action will help guide us with future price action. But I like to use technical analysis to manage risk. I would take it even a little bit further and say that I use it primarily to manage risk. And technical analysis to me includes a lot of different things, not just the price chart, but a lot of the under the surface signals. The sentiment comes into play. I mean, there are a lot of things that I think go into technical analysis that I don't think a lot of folks look at often enough. And then, when you're trading, you throw in a dose of perspective. I think that really helps. People get so caught up in what's going on in the moment that you can't focus on the big picture and just understand that what's going on right now is just a really small piece of what is going on in the big picture, the long term. And so we start thinking that, the tail is wagging the dog. And that's usually not the case. It's usually the dog wagging the tail. And so focus on the big picture, and I think that will help. But that's my opinion why technicals work with the 10-year Treasury yield, the TNX, is because, first of all, the TNX is the yield. That's opposite the bond price. It moves inversely, 100% all the time, moves inversely to bond prices. So when the TNX is going down, bond prices are going up. So folks are moving into bonds that's what drives prices lower, drives yields lower. So if it's price action that's driving the bonds, that's the same thing that drives stocks. It's price action. How many buyers do we have? How many sellers do we have? So that's why you're going to see it work. Good morning. Why is stock chart CE higher than yours? Yesterday, 0.7, lower in the DMR. Well, first of all, what I showed in the DMR yesterday, I believe, was a 5-day moving average. I didn't show the individual date data. So what you're looking at, if you pull up the CPCE, here's the individual readings. And I've talked to stock charts about it. This does not tie in to what I get over at CP or CBOE. So I don't know what the difference is there, but stock charts is pretty consistent in terms of how it comes up with its number relative to what's on the CBOE. So I still think it's very useful information. It certainly has worked for me over the years in calling tops and bottoms on a short-term basis. So I think the question here is it's 0.57. That's yesterday. And then what I had should have been the 5-day reading. And so what you do here to get the 5-day reading, the way I like to look at it, I get rid of candlesticks and I go down and I click on invisible. So now if you pull this up, the only thing you see are the moving averages. And then I just go down and I change the moving averages. So instead of 50, I just want a 5-day moving average. Whoops. 5-day moving average. I'll get rid of the 20. And now I'll show it. And now the 5-day moving average is 0.55. But that's taking the last 5 days, adding them up and dividing by 5. Simple moving average. So that's why this is lower than the 57. How to use technicals to target highs or tops? Well, I mean, a lot of times I just let the market tell me. I mean, there are, when we have to forecast, like with the market vision, I rely a lot on perspective. I go back to that big chart, my long-term 100-year chart, and I kind of get a sense of where the market stands, where sentiment stands. Look at the ratios of the intermarket rate relationships, and then just provide what I think is, and history too. Seasonality. I know certain times of the year go up or down for the most part. So I just really try to combine all of that in projecting big picture, the major indices. If you're talking about individual stocks, I mean, the best thing is patterns. Like I showed earlier with the TNX, if you got a head and shoulder top and you break down below the neckline, it gives you a measurement and a target that you can establish. If you've been in a period of sideways consolidation, measure it top to bottom. When you break out of it, basically, I look maybe for that as a measurement going to the upside. Anyway, those would be a couple of quick thoughts. Do you trade extended hours? Only if it benefits me. I don't let first of all, you have to understand that market maker participation is voluntary in after hours. And I know it's just past 9:30, so we're going to wrap up here in a second. But market maker participation in after hours and before market opens is voluntary. So you're not going to have the same liquidity. And prices can move much, much more in both directions because of that. Because you've got trader A and trader B. That's maybe making it way too simplified. But you have a lot of individuals that are out there setting their bid and the ask or whatever, limit orders. You can't use market orders in after hours because there's no market maker to provide that liquidity. So it's just a different market. But if I'm in a stock and I'm looking for something, let's say I hold into earnings, that earnings would probably be the one time, the most significant time when I would use after hours. And sometimes it hurts me, sometimes it doesn't. But I try not to be greedy. So if I'm holding a stock into earnings and they come out and they report their numbers and they're up 10% after hours, sometimes I just take it. Because if you notice, sometimes companies then go into their conference call and then all of a sudden they say, well, next quarter looks like it might be down just a little from what we've previously thought. And all of a sudden that 10% move after hours is gone. And now you're down 10 or 15%. And so sometimes I'll use that initial reaction. And, it's hard because you think, oh, it's up 10%, it's going to go up 20%. Oh, it's up 20%, it's going to go up 30%. And then by the time it opens the next day, it opens up 8%. And so if it's going in my direction and I can get out and take a nice profit, why wouldn't I? It's kind of my thinking. Or if a stock is, say, at $20 and I see a major overhead resistance at $23 and the stock comes out with its earnings or some other news and it gaps up and it's trading at $22.95. It's like, okay, I don't know if it's going to open above or below, but I'm just going to take, that's where I was targeting this trade, was to go up and hit that resistance. It's hitting it. Why wouldn't I just take it? So those are a couple of reasons. Seasonality report. What is success rate of these 20 stock report? You've also reported actual return. I don't look at it that way because I don't buy stocks solely based on their seasonality. We provide that just as another piece of information for our members to have to attack the market in whatever fashion you want to attack it. What I would use that information for is if you like a stock technically and it's on that top 20 seasonality report, then to me, it's just giving you further evidence of the stock more likely to go higher. Not that it's guaranteed to go higher, but if I like the technicals, let's say I got a stock that just, was going down, and I put on the top 20 list, I don't pay any attention to technicals. I give the best 20 stocks that I can find based on seasonality. And then it's up to you, our members, to do whatever you want to do with it. Would I be in favor of just buying the 20 stocks as a port? No, that is a lot of the stocks technically are broken. I'm not paying attention to what's going on in the charts, but some of those stocks that are broken, maybe they get a gap up, or maybe they break a trend line, or maybe they move through a moving average. And then you look and you see, hey, this is a month that ABC company does extremely well. That's when I would be using the seasonality to support other reasons for buying a stock. You might have a stock that's been doing really well, and it pulls back at the beginning of a month and it hits major support. And then you look and you see, oh, this is a stock that usually does well this month, and it just pulled back for me and it's hitting a major support level. Again, I think that's where the seasonality could come in. Maybe that's the final straw that says, hey, I want to make this trade. In your income portfolio, can you elaborate about that so that I will be better, or I will be able to make the decision to subscribe? Well, we have 3 portfolios. I've said before, our model portfolio and our aggressive portfolio are both aggressive. They're aggressive approaches to the market. If you're interested in using those, first of all, understand we are not registered investment advisors. We are not recommending, we're not giving you advice. We are putting these together. This all started putting these together in an attempt to educate folks on how they can beat the S&P 500. That was the whole idea. And then things just kind of morphed out of that. But the model portfolio and the aggressive portfolio are both, I would consider them very aggressive funds or portfolios. And if you're into those, or you're into some of those, just understand that you should be using aggressive money within your portfolio. If you're somebody that's hunkering down and thinking, I got to preserve my capital, I really want some dividend payers, and I want to just make sure I don't get hit hard, you shouldn't be in the model portfolio or the aggressive portfolio. That's not what that's designed for. The income portfolio, on the other hand, is a much more defensive-oriented portfolio. It's not, I believe we're in a secular bull market, which means probably defensive-oriented stocks are going to lag. Dividend-paying companies are probably going to lag during many periods within a secular bull market. And that's certainly been true in the one we're in. So I don't expect the income portfolio to outperform the S&P 500, which is completely different than the other two. The other two, I'm striving to beat the S&P 500. If it doesn't, over the course of a quarter, then it failed to do what its objective was. And it does fail. I mean, most mutual fund companies, portfolio managers, they can't beat the S&P 500 over the course of a year. We're trying to beat it every 90 days. It's not easy. But those are the goals. Those are the objectives. Someone who is more income oriented might prefer the income portfolio. Again, it doesn't move as fast to the upside. It's probably going to lag the S&P 500 in a bull market, but it shouldn't, in theory, go down as much if we go into an extended bear market. 2021, it did actually underperform, because if you remember, actually 2020 with the pandemic, those defensive stocks actually went down more than the aggressive. The aggressive came flying back, and the defensive stocks didn't. And so, you got to be prepared for any kind of market. But basically, that income portfolio, we try to have at least an average 1% dividend. And in some cases, we'll have stocks in there 2%, 3%, 4% dividends. I think one quarter we had one that had about a 6-7% dividend. Anyway, that's the difference of those 3. All right, it is now almost 9:40, and I do have this live trading room I have to prepare for. So I'm going to get going, but I appreciate your comments. I will try to read through these questions later and maybe try to answer those in a future show, or we'll do this again. But I really appreciate you taking the time to come in here, number one, to ask the questions. I'll try to get to some of those in a future show. Let's take a quick look, see what the market is doing. Well, it looks like maybe we've pulled back a little bit from where we were pre-market leading into, coming back down a little bit. Small caps, though, mid caps got off to a really good start after a not so good day yesterday. So that's good. But they are pulling back just slightly. Anyway, that is it for me. VIX, by the way, down a little bit further, 1279. Anyway, that's it for me. Really appreciate everybody tuning in. Again, please hit that like button. Subscribe to the channel. It will help us in a number of ways as we try to grow our community. And if you would like to take out our service and try it, this is the best time you're ever going to find to do it. These are the lowest prices. Go back to that fall special. Go to EarningsBeats.com and make sure you sign up using our fall special. It expires tonight at midnight. Have a great day, everybody. Happy trading.